Two Canadian freelancers. Both run successful businesses on platforms like Fiverr and Upwork. Both generate $150,000 in gross revenue this year, with $40,000 in legitimate business expenses, leaving $110,000 in net business income before tax. The first operates as a sole proprietorship, which is what almost every freelancer defaults to automatically, often without ever making an explicit decision to do so, simply because it requires no paperwork to start and is the default structure the CRA assumes you are using the moment you start invoicing clients under your own name. The second operates through an incorporated company, a separate, distinct legal entity that they deliberately set up specifically to hold this same business activity. Both earned the identical $110,000. Both did the identical work. And by the end of this video, you will understand exactly why the second freelancer can end up with meaningfully more usable after-tax wealth than the first, while simultaneously exposing personal assets, their home, their car, their personal savings, to dramatically less legal risk than the first freelancer carries every single day their business operates. This is not a video claiming everyone should incorporate. For many freelancers, particularly those just starting out or operating at lower income levels, a sole proprietorship is genuinely the correct, simpler choice, and this video will tell you exactly why. But there is a specific point. A real, calculable dollar amount of income, where the math flips. And staying a sole proprietorship past that point starts costing you real money every single year you delay the decision. This video walks through exactly how to find that number for your own specific situation. Before any tax math, there is a separate, equally important reason this decision matters that has nothing to do with how much you earn: personal legal liability. The core legal fact about a sole proprietorship: when you operate as a sole proprietor, there is no legal distinction between you, personally, and your business. You and the business are, in the eyes of the law, the exact same entity. This means that if your business is ever sued by a dissatisfied client, by a contractor you hired, by anyone alleging the business caused them harm or financial loss, the plaintiff is not just suing the business. They are suing you, personally, directly, with no legal separation whatsoever. What this means practically: if a judgment is awarded against a sole proprietor's business that exceeds what the business itself can pay, the plaintiff can pursue the proprietor's personal assets to satisfy that judgment. Their personal bank accounts, their personal investments held outside specific protected registered accounts, potentially their home equity and other personal property. Because there is no legal wall separating business assets from personal assets when no corporation exists to create that separation. The core legal fact about a corporation, by contrast: when you incorporate, you create a separate, distinct legal entity, the corporation itself, which the law treats as its own person for many legal purposes, separate from you as an individual. If that corporation is sued, the plaintiff is generally suing the corporation, not you personally. And a successful judgment against the corporation generally can only be satisfied using the corporation's own assets, not your personal assets, a principle commonly referred to as the corporate veil, a foundational concept in corporate law specifically designed to allow individuals to take on business risk without exposing their entire personal financial life to every risk their business activity creates. Why this matters specifically for online freelancers and gig economy workers, who often underestimate this risk. A common misconception among freelancers providing digital services, writing, design, consulting, development, marketing, is that liability risk is primarily a concern for businesses with physical operations like a contractor whose work could cause a physical injury. This is inaccurate. A freelance consultant can be sued for professional negligence if their advice causes a client financial harm. A freelance developer can be sued if a piece of code they delivered causes a client's system to fail and lose revenue. A content creator or marketer can be sued for issues ranging from breach of contract to defamation to intellectual property disputes. This risk exists regardless of income level. A freelancer earning $30,000 a year carries the exact same category of unlimited personal liability exposure as one earning $300,000, even though the tax math covered in the rest of this video differs dramatically between those two income levels. An important caveat on the limits of this protection: the corporate veil is not absolute. A director or officer of a corporation can still be held personally liable in certain specific circumstances. For example, if they personally guarantee a business loan or lease, a common requirement small business owners encounter when seeking financing. If they commit fraud or are found to have improperly mixed personal and corporate funds, a practice the law refers to as failing to respect the separateness of the corporation, or for certain specific statutory obligations like unremitted payroll source deductions. Incorporation reduces, but does not eliminate, every form of personal liability exposure. Your action step: regardless of your current income level, explicitly consider whether your specific freelance or business activity carries a realistic risk of being sued for an amount that could meaningfully exceed your business's own assets, and treat that risk assessment as a separate, parallel consideration to the tax math covered in the rest of this video, not something that only matters once you cross a specific income threshold. Here is the vault from the opening, the specific mechanism, and the specific income range where the math genuinely flips in favor of incorporating. The core mechanism: the small business deduction. Canada's tax system applies a significantly lower corporate tax rate to the first $500,000 of active business income earned by a Canadian-controlled private corporation each year. A preferential rate commonly referred to as the small business deduction or small business rate, which combines a federal small business rate with a provincial small business rate, the combination of which produces a total combined corporate tax rate on this income that sits meaningfully below typical personal marginal tax rates at higher income levels. The exact combined percentage varies by province and is periodically adjusted, so verify the current specific rate for your province. But the structural gap itself between this preferential small business rate and standard personal income tax rates has been a stable, long-standing feature of the Canadian tax system for many years. Why a sole proprietor cannot access this rate at all? A sole proprietor's business income is not taxed separately from their personal income in any way. It is simply added directly to their personal income and taxed entirely at their personal marginal rate, which, as covered in this channel's other tax-focused videos, rises progressively as income increases, reaching combined federal-provincial rates in many provinces of roughly 40% to over 50% at higher income levels. There is no mechanism within a sole proprietorship structure that provides access to anything resembling the small business rate. That preferential rate is available exclusively to income earned and retained within an incorporated company. The side-by-side comparison that reveals where the gap actually matters. At lower income levels, for example, a freelancer with $40,000 to $60,000 in net business income, the freelancer's personal marginal tax rate on that income is typically still relatively modest, in many provinces in a range not dramatically different from the small business corporate rate itself, meaning the tax rate gap benefit of incorporating is comparatively small at this income level, while the additional accounting, legal, and administrative costs of running a corporation, covered fully in Segment 4, are a fixed cost regardless of income level. At this stage, incorporation's tax benefit alone frequently does not yet outweigh its added cost and complexity for many freelancers, meaning the liability protection covered in Segment 1, not the tax math, is typically the more compelling reason to consider it at this stage, if any. Where the gap genuinely widens. As net business income climbs into the range where personal marginal tax rates rise substantially, commonly somewhere in the broad vicinity of $80,000 to $100,000 of net business income and upward, varying by province, the gap between the personal marginal rate that income would otherwise be taxed at and the considerably lower small business corporate rate available inside a corporation becomes large enough in absolute dollar terms to meaningfully outweigh the added cost of running a corporation, particularly for a freelancer who does not need to withdraw all of their business income personally each year to cover their living expenses, a critical condition explored fully in Segment 3. A specific illustrative example using Maple Codon-style round numbers and an illustrative, not current year-specific rate gap. A freelancer with $150,000 in net business income, taxed entirely as personal income at a sole proprietorship's full marginal rate, might face a combined effective tax rate in the broad vicinity of 35% to 40% on that income in many provinces, leaving a meaningful but reduced after-tax amount. The same $150,000 earned inside a corporation, taxed first at the considerably lower small business corporate rate. Commonly cited illustrative combined rates across provinces have historically sat in a range roughly between 9% and 13%, though you must verify your specific province's current rate. Leaves substantially more of that $150,000 intact inside the corporation immediately after the corporate-level tax is paid, before any further consideration of how and when the owner eventually withdraws that money personally, which is the subject of Segment 3. Your action step. Calculate your own current personal marginal tax rate at your specific net business income level, using your province's actual current tax brackets, and compare that rate explicitly against your province's current small business corporate tax rate, verifiable through your provincial government's tax website or a qualified accountant. The size of that specific gap, multiplied by how much of your income you can realistically leave inside the company rather than withdrawing immediately, is the foundation of the entire incorporation decision. Here is the single most important, frequently misunderstood condition that determines whether the tax rate gap covered in Segment 2 actually translates into real savings or remains a theoretical benefit that never materializes. The core principle, the small business rates benefit, applies specifically to income left inside the corporation, not to income withdrawn personally. The moment you withdraw money from your corporation for personal use, whether through a salary, reported on a T4 slip, just like traditional employment income, or through a dividend, a distribution of the corporation's after-tax profit to its shareholder owner, that withdrawal becomes subject to personal tax in your hands, in addition to whatever tax the corporation already paid on that income. This is an intentional feature of the Canadian tax system, designed broadly to ensure that income is ultimately taxed at a rate comparable to what it would have faced had it simply been earned personally from the start, once it is actually taken out of the corporation and used for personal purposes. A principle generally referred to as tax integration. Why this means incorporation is most powerful, specifically for income you do not need to withdraw immediately. If a freelancer needs to withdraw the entire $150,000 of net business income from Segment 2's example to cover their personal living expenses every single year, the meaningful tax deferral advantage of the small business rate is substantially reduced, because nearly all of that income will eventually flow through to the owner personally and face additional personal tax upon withdrawal regardless. The genuine, lasting tax advantage of incorporation is concentrated specifically in the portion of business income that an owner can afford to leave inside the corporation, unwithdrawn, for an extended period. Money that then compounds and grows inside the corporation at the lower, already paid small business tax rate, rather than being immediately reduced to a lower after-tax amount by the higher personal marginal rate the moment it is earned. A concrete illustration of this retained earnings advantage. Suppose a freelancer's business, after withdrawing enough income to cover personal living expenses, has a genuine surplus of $40,000 per year that is not needed for personal spending. As a sole proprietor, this entire $40,000 surplus is taxed immediately at the full personal marginal rate the moment it is earned, leaving a reduced amount to actually invest. Inside a corporation, this same $40,000 surplus is taxed first at the considerably lower small business rate, leaving substantially more of it intact to be invested inside the corporation itself, meaning a meaningfully larger initial amount begins compounding from year one, a benefit that grows larger every additional year. The money remains invested and untouched because the larger starting base continues compounding on itself. The dividend mechanism, how an owner eventually accesses corporate funds with favorable treatment. When a Canadian-controlled private corporation that has paid tax at the small business rate eventually distributes its after-tax profit to its owner, that distribution typically takes the form of a non-eligible dividend, sometimes called an ordinary dividend, distinct from the eligible dividend designation covered in this channel's dedicated dividend taxation video, which applies to dividends from income taxed at the general corporate rate rather than the small business rate. Non-eligible dividends receive their own specific gross-up and dividend tax credit treatment, distinct from both ordinary employment income and eligible dividends, designed specifically as part of the broader tax integration system to coordinate with the small business rate already paid at the corporate level. Meaning, an owner choosing to pay themselves through non-eligible dividends rather than a T4 salary is making a deliberate choice between two different tax and benefit eligibility pathways, each with its own specific trade-offs. Salary creates RRSP contribution room and CPP contribution history. Dividends generally do not, a genuinely important consideration covered further in Segment 4. Why the salary versus dividend decision is not simply always choose whichever has the lower headline tax rate. A salary, while often taxed somewhat more heavily in the immediate year than an equivalent dividend withdrawal at certain income levels, generates RRSP contribution room, which dividends do not, and builds CPP contribution history toward future retirement benefits, which dividends also do not. Meaning an owner who exclusively pays themselves through dividends for their entire working life may optimize their immediate year tax bill while simultaneously foregoing meaningful long-term retirement savings infrastructure that a salary would have provided. A trade-off requiring genuinely individualized analysis rather than a simple, universal rule. Your action step: calculate realistically how much of your net business income you genuinely need to withdraw each year to cover your actual personal living expenses, versus how much represents a true surplus you could afford to leave inside a corporation if one existed. Because that specific surplus amount, not your total gross or net business income, is what actually determines the real dollar magnitude of the incorporation tax advantage in your specific situation. Incorporation is not free, and a complete, honest decision requires weighing the genuine costs covered in this segment against the benefits covered in segments 1 through 3. The recurring costs of operating a corporation, annual accounting and corporate tax filing fees. A corporation requires its own annual corporate tax return, distinct from, and in addition to, the owner's personal tax return, typically prepared by an accountant given the added complexity, commonly costing a meaningful sum annually depending on the complexity of the business and the specific accountant or firm engaged, a genuinely recurring cost that does not exist for a sole proprietor, whose business income is simply reported as a line item on their existing personal tax return. Incorporation setup costs. Initial incorporation, whether done directly through a provincial or federal government portal or through a lawyer, carries a one-time setup cost plus ongoing annual corporate registry filing fees required to keep the corporation in good standing, which vary by province and jurisdiction. Increased bookkeeping complexity. A corporation requires its own separate bank accounts, its own bookkeeping records distinct from the owner's personal finances, and generally a more disciplined, formal approach to tracking income and expenses than many sole proprietors maintain informally, both a direct cost, if outsourced, and a real-time cost, if handled personally. Potential payroll administration, if paying salary. If an owner chooses to pay themselves a T4 salary rather than dividends, this requires registering for and administering a payroll account with the CRA, including remitting source deductions, income tax, CPP, and EI premiums where applicable, on a regular schedule. An additional administrative obligation a sole proprietor does not have, since they personally pay their own tax installments rather than running formal payroll. The Honest Decision Framework, bringing every segment together. Step 1. Assess your liability exposure honestly, independent of income level, using the framework from Segment 1. If your specific business activity carries meaningful professional or financial liability risk, this consideration alone may justify incorporating even before the tax math fully favors it. Step 2. Calculate your personal marginal tax rate at your current net business income, and compare it explicitly against your province's current small business corporate rate, using the framework from Segment 2. Step 3. Calculate your genuine annual surplus, net business income beyond what you actually need to withdraw for living expenses, using the framework from Segment 3, since this specific figure, not your total income, drives the real dollar magnitude of any tax deferral benefit. Step 4. Estimate the genuine annual cost of operating a corporation for your specific situation, using realistic accounting, filing, and administrative cost estimates from this segment. Step 5. Compare the dollar value of the tax rate gap applied to your genuine surplus, Step 2 times Step 3, against the genuine annual cost of incorporating. Step 4. When the tax benefit meaningfully exceeds the cost, on a sustained, ongoing basis rather than a single unusually good year, the math favors incorporating. When it does not, remaining a sole proprietor, while addressing liability risk separately, if relevant, potentially through business insurance rather than incorporation, frequently remains the simpler, more cost-effective choice. A note on the honest, general pattern this framework tends to produce. While every individual situation differs by province, specific surplus amount, and specific accounting costs, this 5-step framework tends to favor incorporation more clearly once net business income climbs into the range where a meaningful, genuine annual surplus exists well above personal living expense needs, commonly, though not universally, somewhere in the broad vicinity of $80,000 to $100,000 of net business income and upward, a range consistent with the tax rate gap discussion in Segment 2. Though your own specific number depends entirely on your own specific surplus, province, and cost structure. Your action step: complete all 5 steps of this framework using your own real numbers, and bring the resulting comparison to a qualified Canadian accountant or tax professional for a final, personalized confirmation before making the actual decision to incorporate. This framework is designed to make that conversation dramatically more informed and efficient, not to replace it. Let's come back to where we started. Two freelancers, identical $150,000 in gross revenue, identical $110,000 in net business income, one a sole proprietor, one incorporated. You now understand exactly why their outcomes diverge, and exactly what determines which structure actually serves a given freelancer better. The liability question stands separately from the income level entirely. Unlimited personal exposure to lawsuits exists for any sole proprietor at any income, the moment they begin operating, and a corporation's liability shield, while not absolute, provides real, meaningful protection regardless of how much the business earns. The tax question depends specifically on the gap between your personal marginal rate and your province's small business corporate rate, and crucially, on how much of your income represents a genuine surplus you can afford to leave inside the company rather than needing to withdraw immediately for living expenses. A condition that, for many scaling freelancers, tends to become genuinely meaningful somewhere in the broad range of $80,000 to $100,000 of net business income and upward. Though your own specific number depends on your own province, your own surplus, and your own realistic accounting costs. This is not a single magic number that applies identically to every Canadian freelancer. It is a 5-step framework. Assess your liability risk, calculate your rate gap, calculate your real surplus, estimate your real costs, and compare the benefit against the cost. That replaces a vague, anxious uncertainty about should I incorporate with a specific, calculable answer for your own actual situation. Complete that framework with your own real numbers. Then bring it to a qualified Canadian accountant for the final word. That combination, an informed framework, followed by professional confirmation, is how a scaling freelancer makes this decision with genuine confidence rather than guessing.